The personal finance world spent the last 20 years selling you a lie. They told you that a bank is a safe repository for your hard work. A neutral institution designed to safeguard your capital, facilitate your commerce, and hand you a crisp plastic debit card as a badge of entry into the modern economic system. It isn't. A bank is a business. It is a highly optimized, cold, and calculated entity that processes human behavior into corporate margins. And here is the core reality that no branch manager will ever admit to your face. The bank does not have a single, unified method for treating human beings. The banking system is a variable lens. It dynamically reconfigures its rules, its algorithms, its fees, and its entire structural posture based entirely on a single metric: your leverage. If you view banking as an emotional relationship built on trust, loyalty, or the length of time you've held an account, you will remain a permanent casualty of their balance sheet. If you view it structurally, you can turn the machine inside out. Today, we are going to strip away the marketing, the mahogany paneling, and the relationship brochures. We are going to walk through the 5 precise levels of the wealth ladder, from exactly $0 to 25 million. We will expose exactly what the bank is doing behind the closed doors of their risk committees at every single stop. And more importantly, we will look at the cold, unyielding math that dictates how they switch from treating you as a harvestable crop to an institutional partner. Let's begin at the absolute bottom, level 1, the air tier. When your account balance fluctuates between $12 and a few $100s, money is not an asset. It is not something you allocate, hedge, or manage. Money is simply oxygen. Either you have enough of it to breathe through the next 48 hours, or you are already suffocating in a low-frequency hum of constant predatory arithmetic. At this level, you believe the bank is a place you go to protect what little you have. But the reality is far more cynical. To a retail banking institution, individuals at zero net worth are not customers. They are a high-margin, highly predictable profit center driven entirely by penalties. Consider the architecture of an overdraft fee. If your account drops below zero because you authorized a $9 transaction for food on the wrong day of the week, the bank doesn't simply reject the transaction to protect your liquidity. Their automated system processes the charge, deliberately steps aside, and applies a $35 non-sufficient funds penalty. Let's look at the raw mathematical reality of that interaction. A $35 penalty on a $9 transaction is an immediate 388% financial penalty for the crime of running out of capital. If a predatory payday lender structured an annualized percentage rate that mirrored that exact transaction, it would be illegal under federal law. But when a multi-billion-dollar commercial bank wraps it inside a retail checking account agreement, it's labeled an administrative convenience charge. Why does the bank punish you for being broke? Because at this level, you have zero structural leverage. You represent a high operational cost to the retail branch system. You use their ATMs, you walk into their lobbies, you occupy the time of their lowest paid tellers, and you provide the institution with zero lendable liquidity. To offset your operational cost, the bank converts your behavioral mistakes into revenue. They charge you $12 a month simply because your balance dipped below their arbitrary $1,500 minimum. They charge you $2.50 to access your own cash from a machine owned by a competitor. They charge you for paper statements. They systematically extract capital from the exact demographic that can least afford its extraction. The first rule of the air tier is brutal. Your emotional relationship with the bank at zero is characterized entirely by fear and friction. Every notification is a potential crisis. Every card swipe is a calculation. The system is designed to keep you trapped in a loop of minor liquidations, where you are constantly paying a premium for immediate liquidity. If you are trapped on this first floor, your primary financial objective isn't maximizing yield or picking investments. It is the immediate, aggressive accumulation of baseline liquidity to clear the bank's penalty thresholds. You must build a permanent wall of capital, even if it's just $2,000, that acts as a shield against the automated penalty algorithms of the retail system. You need to stop paying the bank for the privilege of holding your lack of money. Level 2. The product tier. You have spent 2, 3, or 4 years fighting your way out of the air tier. You've automated your savings, you've managed your discretionary inputs, and you look at your banking application to see a stable balance between $10,000 and $50,000. For the first time in your life, the baseline anxiety clears. You no longer check your account balance while standing in line at the grocery store. You feel responsible. You feel safe. You believe you have finally transitioned into a valued customer of the institution. This is exactly where the bank wants you. Because at level 2, your relationship shifts from being a source of penalty revenue to a source of incredibly cheap, harvestable raw materials. Let's look at the case of a standard depositor. Let's call her Maya. Maya has worked hard and stacked $20,000 into a traditional checking or savings account at a major national retail institution. Her bank mobile app shows her clean charts, gives her a free financial health tracking tool, and occasionally throws her a notification thanking her for her loyalty. Maya's account pays her an interest rate of 0.45% annualized, the current national average for standard retail accounts. On her $20,000, the bank will pay her exactly $90 over the course of an entire year. But let's trace the hidden life cycle of Maya's $20,000 the moment it hits the bank's electronic ledger. The bank doesn't sit on that cash. Under modern fractional reserve banking principles, your deposit is not stored in a vault waiting for you to withdraw it. Your deposit is legally classified as an unsecured loan from you to the bank. You are lending the bank your capital, and they are paying you 0.45% for the favor. The bank takes Maya's $20,000 and immediately unbundles it into their broader asset portfolio. They lend $5,000 of it to a consumer down the street via a Premier Rewards credit card at an annualized interest rate of 21.49%. They take another $10,000 and allocate it toward a prime auto loan asset at 7.5%. They take the remaining $5,000 and purchase risk-free, short-term United States Treasury bonds yielding over 4.5%. When you aggregate the return on those assets, the bank is generating an annualized yield of roughly 11% on Maya's capital. 11% of $20,000 is $2,200. The bank pays Maya $90, keeps $2,110 for themselves, and Maya walks away feeling secure because the mobile app gave her a gold star icon for hitting her savings goal. This is the savings account trap. The bank uses your psychological need for safety to fund their entire lending operation with near zero-cost liabilities. They build massive glass skyscrapers and fund multi-million-dollar marketing campaigns. Using the interest rate spread, they slice off the back of uninformed retail savers. At this tier, the bank treats you with polite, automated compliance. They drop the monthly account maintenance fees because your balance meets their threshold. But they will never call you to tell you that you are losing purchasing power to inflation. Every second your money sits on their balance sheet. To break out of the product tier, you must realize that the traditional savings account is an obsolete financial instrument for wealth creation. It is a convenience tool for immediate monthly operational cash flow. Nothing more. The moment your capital exceeds a basic 3-month emergency threshold, you must stop being the bank's cheapest supplier of raw capital. You must cut out the middleman and begin deploying your excess liquidity directly into market-yielding instruments. Level 3. The mass affluent trap. You have crossed the 6-figure threshold. You have a comma in your liquidity metrics, and your total liquid net worth sits somewhere between $100,000 and $500,000. Suddenly, the baseline behavior of the institution changes overnight. You are no longer routed to an automated customer service queue when you call. Your mobile app upgrades its interface. You receive a personalized letter signed by an individual with a title like Preferred Relationship Manager or Vice President of Wealth Management. They invite you into a private office behind a frosted glass door. They offer you sparkling water in a real glass. They hand you a heavy metal credit card with no foreign transaction fees and priority airport lounge access. It feels like validation. It feels like you have finally crossed the threshold into the elite tiers of the economic hierarchy. But let's analyze the structural engineering behind this sudden display of corporate hospitality. This is the mass affluent trap. And it is one of the most profitable psychological mechanisms in modern finance. When your liquid net worth reaches $300,000, you represent a specific risk to the commercial banking machine. You have enough capital to become dangerous to their business model. You have enough money to realize that you don't need them anymore, that you can move your assets to an independent brokerage house, buy low-cost index funds, or acquire direct treasury portfolios without paying a retail toll. To prevent your liquidity from escaping, the bank activates its relationship management layer. The sole objective of a preferred relationship manager is not to grow your wealth. It is to maximize the bank's share of wallet. They want to anchor your assets inside their ecosystem so firmly that moving them becomes a psychological and logistical nightmare. How do they do this? Through the illusion of prestige and the cross-selling of proprietary high-margin financial products. Your relationship manager sits you down and looks over your balance sheet with a manufactured expression of concern. They tell you that you've done an incredible job building a foundation, but now you need professional optimization. They pitch you on their in-house managed portfolio models. Proprietary mutual funds or wrap accounts wrapped inside an annual management fee of 1.25% to 1.5%. Let's run the cold math on a 1.25% asset management fee on a $300,000 portfolio over a 10-year horizon, assuming a standard 8% market return. Over 10 years, that 1.25% fee won't just cost you a few $1,000s. Because of the lost compounding effect of the capital removed from your account, every single year, to pay the bank's asset managers, that fee will siphon off more than $45,000 of your net equity directly into the bank's profit columns. The bank didn't take any of the market risk. You did. But they took a structural slice of the upside simply for providing a spreadsheet model you could have replicated on your laptop in 4 minutes. But the trap goes deeper. Once they have your investments locked in, they pitch you on an in-house jumbo mortgage or a premier home equity line of credit, offering you a microscopic 0.25% discount on the interest rate if you maintain your liquid deposits with them. They aren't doing you a favor. They are locking you down. By linking your primary residence, your consumer debt, your liquid checking accounts, and your investment portfolio to a single institution, they ensure total containment of your financial life cycle. You are no longer a customer. You are a captive ecosystem. When you are the first in your family to build this level of capital, this is the floor where most people stall out. They get intoxicated by the performance of wealth. The metal cards, the premium customer service lines, the polite check-in phone calls from their advisor, and they fail to see that they are being systematically milked by an institutional fee engine. Level 4. Private banking. The moment your liquid net worth crosses the 7-figure line, $1 million to $5 million, the commercial banking system stops looking at you through the lens of retail products. The glass doors of the local branch disappear entirely. You are assigned to an entirely separate corporate division, private banking. At this floor, the bank's core strategy flips upside down. From level 1 to level 3, the bank's objective was to extract cash from you via fees, spreads, and managed accounts. But at level 4, they realize you understand the game. You know the math. You aren't going to buy their retail mutual funds, and you aren't going to pay a $35 overdraft fee. So, how does the bank make money off a millionaire? They stop trying to take your cash, and they start showing you how to borrow theirs. This is the entry point into sophisticated asset-backed debt structures, specifically the securities-backed line of credit, or Lombard loan. Let's assume you have $2 million sitting in an equity brokerage account, compounding quietly in institutional index funds. You decide you want to purchase a commercial property or a high-value asset worth $1 million. A retail consumer at level 2 would liquidate a portion of their portfolio to fund the purchase, triggering a massive taxable capital gains event, potentially losing 20 to 30% of their liquidated equity directly to the state in the process. Your private banker sits you down in a leather-backed chair and tells you that liquidating your portfolio is an amateur mistake. Instead, they offer to wrap a custom debt facility around your equities. They treat your $2 million stock portfolio as collateral, and they issue you a continuous line of credit for $1 million at an institutional rate pinned directly to SOFR, the secured overnight financing rate, plus a thin margin. Let's look at the underlying structural math of this maneuver. By using the bank's debt instead of your own cash, your $2 million portfolio remains entirely intact. It never leaves the market. It continues to compound at a historical 8% to 10% average annualized rate. Meanwhile, you are paying the bank a variable interest rate of 5.5% or 6% on the borrowed million. If your portfolio earns 9% and your debt costs 6%, you are generating a positive structural spread of 3% on money you don't technically own, while completely legal stepping the capital gains tax event. This is the core engine of the modern elite class. Buy, borrow, die. But understand the bank's angle in this interaction. They have achieved perfect zero-risk asset containment. Your $2 million portfolio is legally locked inside their brokerage clearinghouse via a control agreement. If the stock market drops tomorrow by 30%, the bank's automated risk management systems don't take a loss. They trigger a maintenance call. They automatically liquidate your stocks at the bottom of the market to pay off their loan, leaving you with the downside while their principal remains flawless. At level 4, you also enter what we call the villain transition on your family journey. Because you are the first millionaire in your history, you are now surrounded by friends, family, and associates who are still trapped in level 1 and level 2. They see your success, and they look to you as an alternative financial institution. They ask for loans, for business investments, for down payments. The bank knows this, and they provide you with the exact structural shields you need. They set up specialized trust structures, limited liability entities, and separate cash management portals that allow you to say, I cannot access that liquidity. It is structurally tied into an institutional credit facility. The bank becomes your proxy executioner. They play the role of the cold, unyielding calculator so you can preserve your relationships while protecting your principal. Level 5. The architect tier. When your balance sheet crosses $10 million and moves toward $25 million and beyond, you have exited the gravitational pull of the retail financial system entirely. You no longer interact with any branch, any division, or any standard private banking framework you can find on a website. You enter the world of institutional wealth management and multifamily offices. At this level, you do not pitch yourself to the bank to qualify for a loan. The banks pitch themselves to you to retain the right to clear your transactions. You are no longer navigating their system. You are an independent sovereign economy, and the bank is simply a specialized utility provider. Let's look at how the math scales at $25 million. At this volume, your liquidity metrics are large enough to move regional credit markets. If you hold $5 million in raw cash balances, a normal bank cannot simply treat it as an unallocated deposit without disrupting their regulatory capital requirements under Basel III metrics. Instead, the bank builds custom financial architecture specifically for your estate. They design bespoke syndication facilities that split your liquidity across 50 distinct institutions overnight via automated placement networks, ensuring that every single dollar is fully asset-backed and government-guaranteed far beyond standard deposit insurance limits. But the real transformation lives in how they price capital for you. At level 5, you gain access to the bank's institutional trading desk. If you want to acquire an asset, execute a cross-border corporate transaction, or structure an estate hedge, the bank does not look at standard consumer credit matrices. They create custom derivative overlays. They issue you debt facilities at institutional pricing metrics, often submarket rates that track below the true rate of macroeconomic inflation. Think about the psychological reality of this floor. When you can borrow money at an interest rate that is lower than the rate at which currency is losing its value, borrowing debt is no longer a liability. It is a risk-free wealth multiplying machine. You're effectively being paid by the financial system to carry their capital because you have the asset scale required to guarantee its velocity. The bank invites you into private investment syndicates. They show you off-market deals, private equity placements, institutional real estate developments, and sovereign debt portfolios that are entirely invisible to the public. They match your capital with the capital of other family offices, allowing you to operate alongside the bank as a primary lender to the corporate world. At $25 million, the bank treats you with absolute deference. Their risk management officers, their tax attorneys, and their corporate strategists meet with your personal team of advisors every quarter, not to sell you a product, but to calibrate the machine to your bloodline. You have become an architect of the financial system itself. When you step back and look at the entire wealth ladder, from $0 to $25 million, it is easy to look at the banking system and see an architecture of malice. It is easy to say that the system is rigged to punish the broke and reward the hyper-wealthy, but that is an emotional interpretation of a purely mathematical machine. The banking system is entirely apolitical. It has no morality, no empathy, and no vindictive agenda. The bank is simply a perfect mirror that reflects your personal leverage back at you. If you approach the system with emotional vulnerability, using credit cards to perform a lifestyle you haven't earned, or leaving your life savings to rot in a standard retail account because you are afraid of the volatility of reality, the system will exploit your behavior as raw revenue. It has to. That is what its algorithm is programmed to do. But if you approach the system with cold, structural discipline, using each floor of the ladder to secure your liquidity, eliminate consumer drag, cut out high-fee intermediaries, and deploy capital directly into asset-backed infrastructure, the machine stops exploiting you. It begins to serve you. It becomes the exact lever you use to lift your family line out of scarcity and into permanence. The personal finance gurus want you to stay focused on the surface. They want you to debate which credit card points program is better, or which retail checking account gives you a $50 sign-up bonus. We don't play that game here. We run the math that actually dictates the terms of your life. I want you to drop a comment below and tell me exactly which tier of this ladder you are currently navigating. Name the floor out loud, because the first step to changing your position on the wealth ladder is having the total clarity to map your current coordinates. Subscribe to the channel, turn on your notifications, and stop letting the system run your math. Start running theirs. I'll see you in the next one.